Welcome to tonight's show on Eagle City Multifamily, where we talk all things apartments. And today, this is not legal or financial advice. It's simply sharing what we do. And today I want to be talking about apartment investing strategy and why we invest in apartments and how others can invest in apartments. And so I'm going to share my screen here and show you some things today. So the Eagle City Multifamily team is Asif Kumar and Nikki and Sanjeev Mall, and we purchase and operate apartments. And we do syndications. So investors come and invest in these deals with us. And each investor is a direct owner in each apartment. So you can go visit the property. You can see which, apartments you're invested in. And financial planning for generational wealth. Let's look at a strategy today for investing for generational wealth, right? We all want to retire early. We all want to retire wealthy, even if we don't retire early, right? And these are things you can do while you're working your profession, your job, right? And you can invest in these apartments in commercial real estate. And so here's some things you can expect in this presentation. We'll take a look at our financial plans, where you are and where do you want to be. What are you invested in now? And what do you want to be invested in? Are you investing? And why would I invest? Looking at some investment vehicles. And then at the end, I'm going to go over a passive investment breakdown. It's a 14-year chart, and we'll look at it and we'll talk about it a little bit, just for information, to think ahead, to give us some insight for future. And so we may be investing in an old vehicle, and let's look at some investment vehicles that could be a good fit. Step 1, am I investing? Step 2, why invest? Step 3, find the best fit for me. And step 4, how do I get there? And so the vehicle is the investment that takes us to another destination or a larger amount of capital investment. And why invest now? So here's some investment vehicles. There's a big dump truck, right, that hauls big loads slowly but surely. And there's little race cars that get there fast, really fast, but maybe not as safe, right? And so why do we want to invest? And why in apartment investing? And I'll go over some of that a little later in this presentation. Other investment vehicles are like mutual funds, REITs, stocks. By the way, a REIT is a real estate investment trust, which is different than what we do. Stocks, retirement accounts, infinite banking. And by the way, you can invest your retirement accounts in apartments. You can do that if you want to, right? And so we'll look at finding the best fit and how do I get there? So how do I get where I want to go? How do I get started looking? And so apartment investing, there are some government incentives like tax breaks. And let's look at this chart. If you can see my chart on the screen, on the right side, there's years. And then across the bottom, there's different types of investments. So like in the last 100 years, there were 70 years were in real estate, 70 years were positive years, up years, like positive returns. Now, this is national, this is across the country, national. And this is Bloomberg, Barclays, Lehman. So that's where this information came from. And stocks, there were 55 years of positive returns, right? And then bonds have just about the same as stocks. Stocks and bonds about the same as each other. And real estate is higher, right? If you see over 70 years positive returns in real estate, where stocks and bonds were about 55 in that range, positive years. And the negative returns, or down years, which are negative returns, and in real estate, there were only about 8 years in that same time frame that were negative returns. Then over on stocks and bonds, stocks, the negative years were a little over 20 years, bonds a little less than 20 years, down years or negative return years, right? And so it's a better average return over the last like 50 and 100 years, right? And so that's why I invest in real estate. At least a lot of my investment is in real estate, and more specifically in apartments. And I'll talk a little more about that, how our system works, how we manage the apartment investing system. So number one is the acquisition filter. If you can see here on my screen, it's little fine print, but I'll read it for you too, so you can understand. Number one is the acquisition filter. So we're looking at deals constantly. For example, in the last 6 months, we looked at more than 30 deals. Like, we did the full underwriting and we made offers on some of those deals. And then on number two is due diligence and audits and underwriting. And so that's where we did all the underwriting, the analysis to see if the deal makes sense and to see if it is a good investment for us and our investors. And then step number three in our process is the superior management system. So we manage these apartments and we have a process to do that. And we have a lot of third-party management companies in our process to help track expenses, help increase our revenues, and keep our costs down to increase our profits. And step number four is the investment return maximizer. So that's where we increase the net operating income, the NOI, and we want that to increase, right? And to do that, we provide a better community for our tenants to live, right? Create a better community. For example, one of the last we have events at our apartments. We had a back to school event. We've had lots of events like right around at the clubhouse and right around on our properties, and to help the community environment. And so I want to look at a 14-year time frame. And so I'm going to pull up my Excel spreadsheet, and here's a passive income calculator. And these figures are, there's nothing guaranteed here. This is simply for us to take a look and look ahead and see what could happen and what has happened for people, right? And so this is a calculator that right up here in the top right corner. I'll expand this a little bit more so it's a little easier to see. And up here in the top top left corner, there's amount invested per year. So right now it's set on a $100,000 investment per year. And I understand everybody might not put that much investment into investments. We can change that. And I would love to have a one-on-one call with people, with anyone that wants to, we can go over this in your specific case. But for right now, just for simple educational purposes, entertainment purposes, this is set on $100,000 investment per year at a 5% cash on cash return. And I have it set on a 3-year refinance. So, and I can change all these numbers, but for right now, I'm just telling you what it's set on: $100,000 investment per year, 5% cash return, cash on cash return, and refinance after 3 years, and return of capital from finance. So 50% is what I have it set on. Sometimes it's more, sometimes it's less when we do a refinance. And sale after 5 years. Some deals we sell before 5 years. Some deals, maybe it goes a little longer. We've never had one over 5 years yet, but there's I have it set on a 20% profit on at sale, the average annual return. And they're not all that good. Some are better than that, but this is just for entertainment purposes. And I have it set to reinvest all the proceeds. So all the interest and all the returns are being reinvested back into more deals, right? And now we're starting to create an investment vehicle, right? And so, for example, we said it's set at $100,000 per year. Some years it may be less than that. Some years we might not invest anything. Some years we might invest more. But this is a frame of reference to start from. Okay, so, and the 5% cash return, cash on cash, sometimes we're not getting that return. But when we sell it, then we might get more than the total, or we might not. But this is a average return, okay? And so we'll look at our net worth on year one, 100,000, because we put 100,000 in, right? And then we step up as we reinvest the interest and the returns, and then we start to refinance some of the properties. Okay, so, and then it starts to increase. And so, for example, property one is $100,000 investment, for example, in property one, right? In the first year, we invested in one deal, $100,000. And then year two, we did property two. Year three, we did property three. And so we're investing in this scenario, one property per year with $100,000 investment per property. And so we go over and we're looking at, as we look at this chart, it said, so the top line is the net worth on this this scenario, this investment, right? And we have our net capital invested, or new capital invested, and then we have capital invested to date. Okay, so in about, let's look at this as we go across year 1, year 2, year 3, year 4. About year 5, we've at $100,000 per year investment. At year 5 means we've invested 500,000 of new capital, because remember, we're putting 100,000 per year, and in this case, and so we have $500,000 new capital put into it on year 5, right? Year 6, we have 600,000, 7, and so in year 5 and 6, this may be too small to read. If it is, I'm reading some of these numbers for you so you can get a sense of how the investments work. So at year 4, we have 400,000 of new capital invested, with only 333,000 net worth, right, on our investments here. But on year 5, we have 500,000 new capital put into investments in this structure. And so year 5, the net worth is 460,000. So it's climbing. The net worth is climbing, right? It's gaining on our new capital. In year 6, 100,000 a year. Of course, it's 600,000 of new capital invested, but the net worth jumps up to 746,000, right? So it's higher than the new capital, but that curve starts going up. The increase goes faster and faster. Like year 7, 700,000 new capital, but there's over 1 million on the net worth side of it right now, right? Because we're putting the interest that we're receiving, and now on year 5, we're starting to sell some of the properties, and so you're getting that investment back, that return, that initial capital, and we put that into more deals, and it's increasing like a lot faster. So for example, that would continue on its own after a few years. For example, the first property we invest in, we put 100,000, right? And then it's making cash flow, and then we refinance and we get some capital back from that. And then year 5, in this example, we sell the property in year 5 and we take those returns, and now we can take all the initial money invested and the interest, like the capital gains that you receive from that investment, and roll it into the next property and on year 6. And so now it's starting to fund itself, in other words. And you can pull the money out and use it for whatever you want to, right? That's what we all have that choice in this case. But in this case, in this scenario, we're talking about if we would do this, right? If we could, or if we would have enough money, enough capital to operate outside of this, and if we could leave this money, this amount of money in this investment structure, if you will, you would, on year 5, when you sell the property and get your initial investment back, plus the capital gains, and all that could be invested into another deal or two that the next year, and it would grow faster. And in this case, on this spreadsheet, based on the numbers that I was telling you about, it would end up in year 14. So this calculator goes 14 years. And so I'll go back over those terms so you can refresh your mind on how much interest, how much this is set up on, how much investment. And so year 14, in this scenario, you would end up with $6.6 million, actually $6,690,189, when you only put 1,400,000 into this fund, into this structure. Now, this is not an individual fund. This is a passive investor passively investing into individual deals. But now it starts to make more sense because we can see what our money would do. And each dollar is like a little employee out there. $1 employee out there working hard for us, right? And if we have enough of those, like 100,000 a year that we could put into, of new capital that we could put into a deal every year, we would, in this scenario, we would have 6,690,000 where we only put 1.4 million into it, right? And so I'll back up a little and go over the interest amounts again, so you have a clear understanding of putting 100,000 of new capital in per year, and a cash on cash return of 5%, and refinance after 3 years with a 50% return of capital that could go back into deals, and sell each of these deals after 5 years. And in reinvesting all the capital, all the returns, all the proceeds back into deals. And in that case, based on this structure, the $1.4 million in 14 years of new capital put in turns into 6.69 million. And there's been people that I know that have done better than this, and but these are not guaranteed. It's simply a structure set up to help us understand why we're investing in this real estate, these apartments, and that it's a little bit better, in some cases a lot better, than alternative assets like stocks, mutual funds, bonds, other things. So 14 years, that's a long time, right? But real estate is not a get rich quick thing. It's a get rich for sure thing. If you leave your investments in apartment, if you make wise choices, and you leave it in and reinvest it, and if it's something you don't have to live off of day to day, right? You can leave your investment over there and let it grow. And so that's one reason that I invest in apartments and am very pro apartment investing in the quality deals for sure. And so that's why we spend so much time, so much effort into vetting these deals and underwriting the deal and doing due diligence on these deals before we purchase, and then having a great system to manage the properties so we can see the results and the returns from these deals. And so with that, if there's any questions, please come off mute, ask questions, and post your question in the chat for those live, or simply come off mute and ask your questions. And so if not, we will wrap this up for today, and we'll see you next week. So have a great